Welcome to episode 3 of the Farms of BC podcast. My name is Jay Cack, and today we're going to be sitting down with Nav and Taj to discuss everything to do with farm taxes. Stay tuned. All right, guys, podcast number 3. Now, this one's a super important topic. We got tax and everything around taxes and farms. We got a list of 9 topics we want to cover today. So first and foremost, this is a little bit of a disclaimer. We are obviously speaking from our opinion and experience. Yep. This is not professional tax advice. So we do recommend always speaking to an accountant or your tax professional in regards to your own personal situation, because everyone's situation is very different.
That's right.
Now, I'm going to start off with Nav. We got property tax and BC assessment. Now, I can speak to a little bit of BC assessment. I know this is one of those ones, before I got into the realm, I really didn't understand it, because I was seeing farms that are 20, 30 acres for like BC assessment stating that their value is about 100,000, 150,000. Yeah. It's like, it's very jarring because, you know, why is a 6,000 square foot house worth 1 million, 1.5 million, whereas these things are like 100,000 or something like that, right? So maybe you can speak to that.
So when you, anytime you see ALR properties that have a much lower value, sometimes you'll see 50,000 or a couple 100,000, but you'll see and it's like a 5 acre up to a 50 acre. It's based on the property owner declaring that they have farm status. So what the BC assessment or the government does is they will lower the value of your property on purpose, so you pay less property tax. And what the reason why they do that and why farmers apply for it is that they want to encourage people to use their farms for farming. Yeah. So that's kind of where your property taxes will be lower, but your assessment will also be lower, but that doesn't reflect the true value of the property. So I do get this question asked a lot from residential realtors. Now, if you're asking $3 million for this property, but the assessment is $100,000, why? Because they're so used to looking at the BC assessment value to engage what the property is actually worth, which, in all fairness, it makes sense. But when it comes to agricultural properties, that's BC assessment is not the true reflection of your property, even when you don't do that farm tax exemption.
Now, is that the only indicator that you have farm status, or is there some sort of other indicator?
That is one indicator that I've always used. When you see a low property assessment value, and you know the farm is worth more, like much more, that usually gives me an indicator that they have farm status.
I think I'm pretty sure that's the only thing.
That's what I've been using for the last.
I think the only other one that I would use is probably from the tax assessment sheet. The tax report. Sometimes you can tell that the gross taxes are significantly less than what you would think they would be. Yeah. I think that's the only way.
Well, sometimes they have houses, so the house would actually have a significant value if it's new. So you can't judge it like entirely off that.
Yeah, and no, exactly.
So like there's different ways to do to get that farm exemption. So if you own agricultural property, so when you buy a farm, you should be doing this as well if your intention is to farm, is you apply to BC assessment. It's a simple form, and they're going to ask you what type of farming you're going to do, how many acres or how many animals you're going to keep, and then you have to qualify within their checklist that will provide you farm status. So typically when you're farming yourself, and you're over 2 acres, you have to show $2,500 of gross revenue. Yeah. If it's under 2 acres, then you have to show more, because it's hard they wanted to make it harder to justify, because they know that under 2 acres it's not really a farm, it's more hobby. So you need to prove that you're grossing $10,000 a year,
But you can actually lease it to a farmer too.
Yeah.
So you don't have to do the $2,500 yourself, as long as you're showing $1 or more, from my understanding. And as a bona fide farmer farming the land, BC assessment will take that into account too.
Yes, that's right, and that's a way that a lot of our customers are actually doing that, right? Yeah. They're getting around that. Oftentimes, a lot of folks do want to build a larger home on the property, whatever the case may be, and they may have a few acres that they can lease off to a neighbor. They still get their entire house with that farm status, right?
Well, the house will still get taxed based on the house's value, declared value to the city.
The construction value. Yeah.
Right, okay, there you go. So I guess that answers that on the farm status side of things. Now, another fear a lot of folks have is when they're asked to sell their house after 20, 30 years, they're not very familiar with their tax situation, and they always ask, how much is the tax man going to get from me, right? Because is it even worth selling?
Yeah.
Right? So capital gains tax, maybe we can speak to that.
Capital gains tax, each farmer, each owner of the property, so anyone that's on title, gets up to $1 million for capital gains exemption, depending on if you've used it in the past or not. So if you've ever used it, they'll always deduct that amount from the purchase value of the property.
So lifetime value.
Lifetime value. Yeah. So let's say you bought the property for $1 million, and now it's worth $5 million. You have a $4 million gain. So that $4 million gain, if you have two people on title, each of them have about $1 million that they can shelter, and then they'd probably have to pay tax on the additional $1 million.
Wow. So I mean, if you have like 6 people on title or something like that, is that?
Yeah. Now, there are some rules and regulations when it comes to those exemptions. You'd have to be a bona fide farmer, and you do have to, I believe you have to show 51% of your personal income as farming income. Now, I know there's some exceptions, so those are the generic rules, but it's always good. We always advise before any individual that owns ALR properties that are farming to always speak with their accountant before they list the property. Because sometimes if the tax bill is too big, it may not be worth selling. So we always say, figure out your tax bill, take in the commissions into considerations, other costs into considerations before you list, or else you don't want to be in a position where you're under contract, you have a firm deal, and then you realize like, oh man, like 50% of this is going to tax, right? We've even advised property owners not to sell and maybe figure out some tax planning with their accountants. And sometimes it's beneficial to sell in a couple of years because they can do some sort of tax planning and they can fit in that box to trigger those exemptions. And within 2 years later to sell where they can tax shelter a lot of those gains. So
one thing I should point out is that capital gains exemption is lifetime on all your properties, like all your farmland. Right. So it doesn't just apply to each individual property you might own.
Yes. And you know that also grows. So today it might be $1 million. The government can, in a couple of years, bump that up to 1.2, 1.4. So
it
used to be 800,000. Before that, it used to be 600. So it always grew as property values grew to tax shelter to benefit agriculture and farmers. Yeah.
Interesting. I actually didn't know that. That's one huge piece because like I was always under the impression that it was $1 million flat, but you're saying that it can grow over time. In the future, it will grow even more.
It will, but in smaller increments. Yeah. Yeah.
That's huge. That's huge. Now, next topic is property replacement tax.
Yeah.
Right? Maybe you can speak to that.
Yeah. So when you are wanting to grow your agricultural business and you want to sell a smaller piece and get into a bigger piece, the gain on the smaller piece could be tax-free as long as you buy another farm equivalent to the same size or bigger. Because the government really advocates farmers to grow their farming business. So you can tax shelter your entire gain and roll that over to your next property without paying any tax at all, as long as you're going, say, from a 5 to a 5 or 5+.
But there's a timeline that I think you have to execute that.
You have to execute it within about a year's time. I don't know. I forget now. It might be within the calendar year or your cycle of filing your tax return. So speak to your accountant on that, but you can trigger that.
That, or I think you need to show the CRA that there's intent, like that you're actively trying to either sell a property to make the move. Sometimes people buy the property, the bigger one first, and then they sell the property that they want to sell to buy. And in a market like this, when conditions might be tough, the CRA will hopefully look at that.
So you're saying basically it goes from, say you have a 5 acre, but you're going up to a 20, it would roll over in that one.
Yeah, I think even if you did 5 to 5, it would roll over. Say if you took 5 to 2,
Yeah.
then you can tax shelter 50% of it, not 100. So they'll they'll scale it according to what you're doing next.
So in that situation where you're going 20 to 5, it's still 50%?
It would be a quarter then.
Okay.
Yeah, but these there's so many rules and regulations with that is just an overview, like a generic overview. But that's if you're looking to expand your agricultural business or even scale down, but still want to do some farming, but scale down the farming operation. That's something that you want to talk to your accountant. Like, is that before you sell or buy or make a transaction like that, sit down with your accountant and say, hey, is there something here that we can look at before we go ahead and make these decisions?
Huge.
Yeah.
Now, another one is generational rollover tax. Now, there's exemptions in this world where
Yes.
basically you're coming down from your grandparents to the parents and then perhaps to yourself, right, the grandchild. So maybe you can speak to that.
So that one can be tricky, but as long as, from my understanding, is you can roll it over to your children. The children have to be bona fide farmers as well, and they have to keep farming for it's a 3 year, it's a 3-year rule.
Yeah.
So they have to farm for 3 years before they were to ever sell or use their capital gains, I believe.
Yes. So the individuals, so you can only pass the farm down. So grandfather to father to kids, and then but say if the kids wanted to use their $1 million capital gains exemption as well, they would have to be bona fide farmers for 3 years in order to trigger that.
So they'd have to show income from the farm as well.
Is that prior to or after that? Because do they have to be 3 years farmers before they can receive it?
After.
The parents, the parents can pass it on to the children.
So the parents can use their capital gains, right? And then the children, if they ever decide to sell in the future, they then will be, they'll trigger that $1 million capital gains exemption. But say if they wanted to pass it on to their kids, that entire gain that's been built up, it'll just be rolled over to the next generation tax-free.
Wow.
But eventually you'll get taxed when
someone sells eventually, like you'll have to pay it. All you're doing is just prolonging it, and so the farming operation and the next generation can continue growing it.
But it's a good way to build wealth, because you look at other types of properties, residential homes, development properties. Each sale you're triggering a tax, so it doesn't help or allow you to grow your portfolio as fast. Whereas on farmland, generationally, you can pass it down tax-free, which helps retain a lot of the equity and cash flow, and then the kids can keep growing up.
That is a huge benefit for legacy, right? At the end of the day, you're passing down that legacy. And that's another really big reason that a lot of folks aspire to have acreages or farms. And I guess one question I have, and would it be possible for a brother to pass it to a brother? Or a family member, a daughter to pass it to a daughter?
So like if you're going sideways instead of so you're still going to get triggered tax because it's a transaction. But say if you own two 20-acre parcels or properties, and say husband and wife are on one, and because we've seen this, and then another brother and his wife are on the other, but they all jointly own these two together, they can split the parcels because they're equal value without triggering any property transfer tax. But when you do a sale, when you say if a brother decides to buy out one of the brothers or sisters, there will be that will trigger property transfer tax.
Yeah, but I think the parcel has to be equal size, equal value.
Correct.
Most likely in the same municipality for value, and I think the use has to be the same too.
Yes.
I could be wrong, but
there's a few trigger points that you have to qualify, right? So you just got to make sure that, again, like these transactions they're very large, and they, it takes a few meetings or a few planning sessions with your accountant, and figuring this out. Like, there's so many exemptions. There's so many exemptions and exceptions to the rule that, you got to know what you qualify for before you decide to buy out a partner or pass it on to your kids or sell the property, right? Or even when you're purchasing the farm.
Yeah, and I mean, once you have that knowledge, you can kind of more accurately move forward instead of kind of just winging it, right? So
Yeah.
at the end of the day, when you're kind of getting a property evaluation, it's great to just think about, oh, that's the value I can get right now.
Yeah.
But in reality, you might not be pocketing all of that, right?
That's
So
right.
you really want to have that professional advice.
And there are a lot of accounting firms here in the Valley, Greater Vancouver, that specialize in this, in agricultural properties. And they're very well diverse, they're very well known, they're very reputable.
And vice versa, there's a lot of accountants that don't do much of this as
That's
well, right? So you really gotta,
There's times where we've seen that a property owner doesn't have an experienced accountant in this field. So we always advise them to hire a specialized accountant. Just, you don't have to change accountants, but you hire an accounting firm that's knowledgeable about this and have them do the planning, and then they'll connect your existing accountant in on the decisions that they've made. So when it comes to these one-off big projects, I call them, bring in the professionals, pay their fees, and do a proper plan before you execute.
A lot of people actually think they can't do that. Like a lot of people think that you have your accountant, that you have to stay with your accountant.
That's not
You can always sub out.
Sub-outs, these are considered bigger projects. So you can still keep your existing accountant, bring in one of the bigger accountants that have, the bigger firms that have the experience, knowledge, and expertise, and just sub this project out.
And they would work with your accountant.
Yeah.
yeah, that's really good practical advice that people can apply right away.
That's
I mean,
right.
if they're in that situation. Awesome. Now, we've said this word before, property transfer tax, so
That's
far
right.
in our conversation. Maybe you can elaborate a little bit more on that.
Yeah, I think because the public does know that there are all these farm tax exemptions or exceptions, we always get the question, is property transfer tax applicable? Or is there a discount? So property transfer tax is the same as residential. So nothing will change there. The only time you'll see property transfer tax being exempt is when you do a share purchase agreement, but that doesn't only apply to farms, that also applies to any other real estate holdings and assets.
And I mean, I guess we can dive into this since we're leading into it already. But benefits of purchasing with shares, what is that?
Well, there's two ways to purchase property. There's either you buy it under your personal name or you buy it under a corporation. So there are pros and cons to both. One, buying it under a company, you may be depend. So the way when a buyer is looking to purchase, the reason why we always say take the advice of your accountant to which way to go is depending on your existing portfolio. Your other investments you have, do you already have a principal residence? So when you're buying a property with a house on it that you know you're going to make your principal residence, because there's a tax exemption on the principal residence, most accountants will say put it under your personal name. But now say if you're buying a property that doesn't have a residence, nor do you plan to live there, most of the times your accountant will say, hey, put it under the company because it's an investment. So depending on your existing and your future plan, your accountant will advise you, hey, put it on your personal name or your company name.
Yeah, and what the company is, if you have a strong business already and you have good cash flow and you have good income in your company, the accountant might advise you to buy under the company because that's where the funds are coming from, right? There's often cases where people buy it under their personal names and they'll lease it to their company. That just adds a layer of protection for liability, which is another whole different topic.
Yeah, absolutely. And I mean, another thing kind of more relevant in the real estate world for us that we see all the time is that a property may get sold and there's new ownership because the company's shares got sold out, but we just don't know it's new ownership because on paper it doesn't look like anything changed, or whatever the case may be, right?
Yes, on the tax, it won't show the sales transaction. The directors would have changed, but
you still want to make sure the company's in good standing too. They have no lawsuits pending against them.
Yeah.
So when you're doing a share purchase sale, there's a lot of homework you need to do because you could take on that company's liability.
Yeah. So what we typically do when there is a share purchase sale is we always advise to get the accountants and lawyers involved prior to completion and confirm that the company is in good standings, like Dodge said, but also to we always put this indemnity clause, which will allow, which will protect the buyer that when they're purchasing, that any liability prior to the completion date would be on the seller, and anything forward will be on the new purchaser. And you'd also have to look at if they own other assets and how that affects everything, right? So you can do a share purchase. Sometimes as a seller, it is more beneficial to do a share purchase depending on how big your gain is. And for a buyer, it is sometimes beneficial because you avoid the property transfer tax. But again, there's a risk to that. There's liability to that. So getting the accountants and lawyers together before completion and going through that process is very important.
And I guess that leads us into one of the other big ones, GST on farm purchases. So if you're in a company now, is that still relevant as well? You're still paying that when you're selling the shares?
So if there's an operating business and it's a farm operation and there's revenue, then there will be GST applicable. Now, when it's just a residence, then there won't be GST applicable. But there are ways around that by self-assessing and speaking to your accountant to see if GST, if there's ways to exempt or defer is what they call it, the GST.
Mm-hmm. I think that's the biggest one that we hear a lot about.
We get it a lot, and you know what?
It's a tricky one.
Yeah.
But you need to get a personal GST number. But
if you buy it under your personal name, yes.
If you buy it under your personal name, but it's not, from my understanding, it's not fully exempt. Like you don't pay it when you're purchasing the property, but it's some sort of deferment.
It defers to the next purchaser, but if they provide themselves with the GST number on their completion, then it just kind of gets rolled over. But again, it's really crucial to kind of look at, because each farm is not, there's no right or wrong answer. Is GST applicable or not? It depends on the property and what the existing use is, plus what the buyer's intention is, right? So that's kind of where GST applies. But again, that same circumstance, because it's not a straightforward answer, a black and white answer, I've always advised every buyer to put a subject in there to confirm with their accountant if GST is applicable or not.
Absolutely. And I mean, that's a huge one because it can be a sticking point because that's not a small amount.
It's 5% of the
huge.
purchase price. Yeah.
More than the people too.
Yeah. So it's one of those things that we do want clarity on at the end of the day before moving forward, right?
That's right.
Absolutely. Now, moving over to the next one, I know we mentioned principal residence exemptions.
Yes.
Did you guys want to elaborate a little bit deeper on that part?
Yeah. Yeah. So if you have, just like any residential home, if you've lived in it for more than 3 years, you sell it, the entire gain is tax-free. Now for farmland, the way the government declares your principal residence as tax-free is they only allocate 1.25 acres around the house as your personal enjoyment that will be tax-free. So when you sell, say, a 20-acre farm, there's a separate exemption for your principal residence exemption. Then they look at your capital gains exemption. Then they look at your rollover exemption, depending if you're buying a farm. So you may be able to trigger all three of those, depending on the situation. But there has been case study, and people have won in court, even if it's a 100-acre parcel. Even if it's farmed or not farmed and it has a house on it, it should be tax-free. The reason their justification is because ALR properties are not allowed to be subdivided, you cannot, that is the smallest piece that it can be. So the point is that if you were legally allowed to subdivide to an acre or an acre and a quarter, yes, then only give them that exemption because that's the smallest parcel size you can make it. But because you're, according to the Agricultural Land Commission, they don't want you to subdivide farmland. So according to that rule, it doesn't matter if it's 100 acres. That is the smallest parcel that you can make it. So technically, it should all be tax-free. And again, speak with your accountant. Some people, they take that risk, some don't. But there is actual case study out there that farmers have won that it was all fully tax-free.
Wow. And I mean, if they were in that situation, what's the best course of action? Maybe speak to a lawyer, I guess, in that case?
No, just advise with your accountant, right? Now, again, that's the difference of having a professional, qualified, experienced accountant versus someone that's not really experienced in this. They may not know versus they'll tell you the pros and cons of applying it that way.
Huge difference, right? Now, we spoke to this as well, but now we're going to ask you for the magic bullet. Is it better to put the farm under your personal name or under a company name?
Yeah, for myself, though, I personally think it's better to put it under your personal name. I think there's more benefits there. But again, what Taj mentioned earlier, it's all, if you're going to run an operation, I would create the company and lease it from my personal name to my company to tax shelter or to create that liability barrier from my company to my asset. So that's kind of how I've always seen it. But again, it all depends. I've seen larger farmers with hundreds of millions of dollars worth of assets. They won't put it under their personal name.
I've seen the bigger parcels, the 50 to 100 acre pieces or larger. I've seen a lot of those go under corporations.
Big operations.
Yeah, the 10, 15, 20, 30 acre farms, it's mainly been personal names from what I've seen.
So those are the smaller ones then, I mean 20, 30, like 50?
Yes, but like not to say that the bigger ones don't go under people's personal names. It just, you get into more corporate level when you see the bigger farms.
Yes.
So now from your guys' standpoint, what do you guys personally do? And like, that's your advice, but what is it that you guys do for your own farms?
On all our farm operations, we have it under our personal name. And we lease it to our farming operating company.
Oh, wow. Excellent. I mean, at the end of the day, we just covered 9 different topics here. I know it's a dense amount of topics, right? But that was property tax, that was capital gains tax, property replacement. We had generational rollover. We had GST, property transfer tax, obviously, principal residence exemption, and purchasing a farm under personal name versus company. And then lastly, we had share sales.
Yeah.
Huge. Awesome, guys. Well, looking forward to podcast number 4.